Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So Matt, we just actually had what's probably going to be our most downloaded episode ever of Excess Returns. Like the most downloads ever in the first 24 hours. It was with Mike Green from Simplify, and it's like for us at least. I mean, I think other people would probably define going viral a little differently than that, like with bigger numbers. But for us, I'm going to call it going viral.
It's not easy being Green, but it is easy being Mike Green, apparently. Good job, Mike Green. Wow. Those numbers are wild. Thanks, everybody, for watching.
Yeah, and he has so many great insights. Like it's the reason they do really well is because he's doing something truly unique, and that's rare. You know, we can have a lot of people on who discuss very similar things, and all our guests do a great job. But like Mike really has thought about the world with what he's done with passive and some of the ways he looks at other stuff. He's really thinks about the world in a very different way than other people do, and is truly produced something in the passive world that is truly unique that I haven't seen anybody else really talking about.
100%. And I will say, this most recent interview with Mike Green that you and Justin did, I've forwarded this to multiple people. This is going to people on my investment committee at Sunpoint, just as much as this is going to some friends around the industry, because he touches on so many different areas, which is what we're going to talk about today, that are a little bit different perspective, a little bit different of a take than I think you're normally going to hear. And he just has this ability to zoom out on these big ideas where he can explain a concept in a way where you go okay, I have a fresh perspective on how the granular details, because of the way he can operate at such a broad level. Totally respect his thinking, and wonderful episode to share with a friend.
Yeah, we got great feedback when we did this with Rick Ferry, so we're going to do it again, which is we're going to try to take the lessons from that Mike Green interview. I'm going to try to look at it maybe on the investing side more, and you're going to look at it on the planning side more. And we're going to think about just how your average person can think about and sort of decipher these ideas and what they mean in the real world. Because, we do tend to talk about some pretty complicated topics on excess returns. And a lot of people, I think, probably have the question, what does this mean for me? What does this mean for my portfolio? Is it something I should pay attention to? Is it something I should ignore? So that's what we're going to do today. We're going to take the biggest takeaways we took from there. I think we have 9 lessons maybe we're going to go through. And we're going to talk about what we think it means for your average investor.
I think this is a great idea. And I think the connection back to you, this is what's so interesting. When somebody can take you up to such a high level to look at the whole thing with all those granular details still below, you don't just want to be swept up in the excitement for how much sense it makes. You want to think, how do I actually take some of this home to apply to my own strategy, my own financial plan, my own financial reality, which is why we have this list. Why don't you kick us off?
So my first one is actually a lesson for myself, which is be open-minded. I have to be honest, when I first heard Mike's ideas, this idea that money flowing into passive investing could be influencing the market, I was like, well, passive investing is the market. It's not influencing the market. It's just going in according to market cap, and it's having no influence whatsoever. And I think that was kind of a stupid reaction on my part, because I was so locked into thinking in a certain way. And then when you actually look at his data, if you're open-minded about it, if you actually look at his data, if you actually look at all the research he's done and all the academic research we also covered in the podcast, there's something to this. This is not nothing. There's absolutely something to his ideas, that there's an influence here. Now we can disagree on how much of an influence it is, but it's there. And so that was my first takeaway is you often have these ideas, and we find it in politics these days, we find it in investing. You're so locked into a certain way of thinking, and then you hear somebody who's way outside of that way of thinking, and you're like, that's just garbage. I'm not going to listen to that. And I think I did that years ago when I first heard Mike's ideas. And I think it's a good lesson for all of us to say, even if you think this may not be correct, let's look at the data, let's look at the facts, and maybe let's challenge myself.
One thing that he does that I find extremely admirable is it's one thing to cite, same thing. I'm going to go back to this open-minded point. You'll hear somebody articulate a point and you'll hear 3 citations. And I'll use at the beginning of this episode, he's talking about the inelasticities of the inelastic markets hypothesis, some stuff like that. And he throws out a couple of the papers, a couple of things that help shape his thinking. What separates somebody like him from the rest or the norm is those things don't necessarily hold the one and only exclusive answer either. So he's going to explain what he's taking away from these papers, but then he's also going to point out the nuance of saying, but I was still seeing something different than exactly what they were describing. My observations just rhymed. So then I went back to the authors of the paper and I said, this is what I'm also seeing. Can you help me bear this out or prove this with your expertise in testing these things? And then, oh, by the way, here's the new updated published paper on the idea that I had to push this along. Reminding you to zoom out and have an open mind about these things, but then also reminding you again, you can drill into those things with further points and go straight to the sources. That's a really cool thing that you're not often going to hear people challenging their own beliefs, their own priors, their own ways of thinking to the point where they're going to reach out to the person who wrote the paper and say, I've anecdotally observed this too. Is this true? And if so, how would you design a test around it?
Yeah, and I mean, the academic research, and I've read a bunch of it, is really strong in this area. Like it's, there is a lot of supporting research, and I mean, you have a lot of people that sometimes just throw ideas out there and say, oh, I think this is happening. Like this is not what's going on with Mike's ideas here. I mean, there's a lot of academic research to back this up, and I just think all of us as investors, and we'll get into later, like what maybe the practical implications of it are, but all of us as investors should at least think about it and say, like, could this be right? And if this is right, what does it mean? I think those are really important questions to ask.
So can I short circuit this and take you to lesson number 2, just because I think it relates to the follow-up point on this?
Yeah, let's do it.
All right. So your lesson number 2 here was passive investing may have unintended consequences. And this is my question for you. So passive investing, for the most part, seems like a net positive to society. We get passive funds, which have lower costs. We know active funds have typically underperformed these passive benchmarks. Lots of people look at tax efficiencies, all the things in planning and basic portfolio construction that these things help do to give people exposure to assets. But then he raises very intelligently this question of it may have unintended consequences. The first time you heard that, did you think, no, this was crazy? Did you think, no, there must be some tipping point? It must be some very small percentage of the market? When you first heard the questions about active or passive management, how'd they hit you? How'd that evolve for you personally over the years?
Yeah, well, first of all, I think you're right. I mean, I think there's 2 different ways you have to look at this. One is from the perspective of each individual investor making a decision. And from that perspective, Mike's not even arguing that it's a good decision to be investing passively. He's thinking more from a systematic level, or at the level of the entire system. When everybody does that, when everybody makes that decision, like obviously if 100% of people made that decision, you've probably got an issue on your hands. You no longer have any active managers setting price. I mean, we're not there now. I mean, I don't know where we are. 40%, is where he would argue. Some people will argue lower, but there's a lot of products that are pretty much passive that aren't technically 100% passive. And when you add all that stuff together, I think you get in the 40% range. So obviously it's, active managers play a role. They're important. I think also like the idea that passive investing is the right thing for a lot of people is also the right thing. But the question you have to ask, and this gets into his research, is what happens when you've got all these people who are automatically putting money into their 401ks? The way 401ks are structured these days, there's a lot of incentive for the companies, to have the default option be some sort of passive vehicle. If that money just keeps flowing in, it doesn't care about what stocks are expensive. It doesn't care about what stocks are cheap. Does that impact the market in any way? And so in a normal world, you could say, well, Apple's the biggest company in the S&P 500, but Apple's also potentially the most liquid company in the S&P 500. So who cares? If money's flowing into Apple, more money's flowing into Apple, but Apple's also more liquid. But where Mike's arguments come in is this idea that liquidity doesn't scale completely with size. And so basically, as Apple has gotten bigger, its liquidity has gone up, but not as much as its size has gone up. And if that's the case, then those dollars that just keep flowing in could create a distortion where the biggest companies, and this is not something where like Apple's doubling tomorrow, this is like a slow thing over time where it can create a distortion where the biggest companies get bigger and bigger and bigger. And it doesn't mean fundamentals don't matter. I mean, fundamentals are still obviously, NVIDIA didn't go up, what it went up because of passive flows. They contributed to it, but NVIDIA went up what it went up because it had great things going on in its business. But the idea is over time, that could have an impact on the market. And then if it got too much, if it got too big, you could potentially have problems on the downsides, because we talked about those passive flows coming into 401ks, just going in. What happens, and we talked about this in the interview, what happens if that ever reverses? What happens if we have a situation where passive flows go in the other direction? Could we have some sort of bad market situation because those flows are headed in the other direction and the buyers just aren't there? It's an interesting question, and I think his research backs up the idea that this is something all of us should be thinking about.
This concept of this is the part, it's like we have whatever. You can argue exactly what the precise count is. You can probably tell me what the better is. Let's just say you have 50 to 100 years of pretty good stock market historical data. You don't have 50 to 100 years of investment data with the same vehicles that we have in place today. That's such a basic question that just so rarely gets asked when we talk about returns and strategies and everything else. We can't look back at like the 50s and say, did you just buy the S&P 500 coming off of World War II? You know, grandpa or mom or whatever the situation is. Like, did you just buy the S&P 500 index fund? No, because it wasn't really created until the 70s. And even then it wasn't really tradable until the 90s in the ETF wrapper. And that's not an inconsequential detail. This differential between everybody has to go down to a broker and plunk some money down to buy a share of a stock, and then it just might aggregate up to the Dow Jones, if not the S&P, if you have a lot of money. That reality is part of a new reality. So to point out that these new vehicles guide flows, these flows now control all these assets in the sense of like what they own, and we don't really have a way to say, we know how this has been shaped with all this money coming into these passive vehicles. We don't know what that looks like under an extended net outflow environment. Just raising that question, and I think it's the way he put it, but the way you put this too, as unintended consequences. I think that is the correct phrasing of this question. What is the unintended consequence of all this money going into these types of vehicles where just the difference in net inflows changes to net outflows? What could possibly go wrong? That's a question very, very worth asking. Not to fearmonger. It's just an interesting question to ask.
And the answer is, Mike didn't give the answer because the answer is nobody knows. So he's trying to think through what might happen. Like I asked him a question about, what type of market decline could this cause? And his answer was, I don't know, because nobody really knows. But it's just something, to your point, like this is something to think about. And it may not be, and we'll get later into like practical investment implications, there may not be any to this. But it's still something to think about, like just what happens systemically. And it's not going to be, nothing's going to change here because going back to what I said before, in the eyes of the individual investor who's making that passive decision, that is the correct decision. It's not a bad decision. So when that happens, you're not going to go to people right now and be like, you can no longer invest passively because there's some potential of a market meltdown in the future. That's not going to happen. So this is going to play out. Passive is going to continue rising. And, we don't know. I mean, it could end very badly. It could end less badly. We don't know, but I think that's the cool thing about doing the podcast is it gets you to be able to think through these things. Like I would have never thought through just doing what I was doing. I never would have thought through the whole idea of how is this actually working with people's money going into 401ks and qualified options to invest in there. And like that change from cash to, investing in like more of a target date fund at a certain point, like thinking what all that means is something I never thought about before. And I think it's really cool. Like when we get to do these interviews and we get to think through it and say, what does this actually mean? And be able to talk through it with you, like on podcasts like this.
No, absolutely. And it maps over all sorts of other stuff. And I want to say this is where it's important not to get, Mike does a very good job of not getting carried away by these concepts. I think, and I know there's people out there who will take this and map it over to some fourth turning doomerism, like crazy theory. This is not to say passive investing is bad and whatever else. It's also not to say we can exactly understand the way demographics lay into passive fund flows and map it out over the next 100 years based on like the birth rate or something. I mean, you could, but it doesn't mean that that's the thing that's going to play out.
You're ruining my YouTube cover here, Matt. I've got my doom and gloom. I want the click-through rate up. I need my doom and gloom. I was hoping you were going to bring the fourth turning in here so we could, I could somehow use that in the cover.
Demography is destroying modern capitalism with passive fund flows.
It's funny, like just before we go back to that, because we always go off on these tangents. Like I did do my most, like my YouTube cover on this was not aggressive, but I think it was my most aggressive ever. Like I used the risks are rising on there, on my cover because we had talked about like the risks of passive, but we had also talked about like the risks of options or the risks of, short volatility. And so like it was my most, it's also my best click-through rate ever, but it was my most aggressive cover because like I refuse to go to the world of like fire burning on the cover and the world's coming to an end and like, the podcasts that do that get really high click-through rates. I wouldn't do it, but I did go as far as I've ever gone here. Like at least saying the risks are rising is about the most aggressive I get.
Well, welcome to the camp of the risks of rising. You're really getting edgy on this one.
I know.
I have a sub point that I think is important on this one, and it's for you because it's with passive investing. One of the common criticisms of passive investing and passive flows through like the default, the QDIA option and 401ks and everything is that it ignores all valuations, that this is part of the validation that valuations don't matter in this is the terminology that he uses, I believe, that really resonates with me. It's valuations actually don't matter until you're trying to raise equity or borrow money. For the most part, nobody cares. It's kind of like I can say I can buy whatever hell house I want, right? I can make a number up and say like, I could buy a $10 million house tomorrow. Sure. Even if I can't. That statement doesn't matter until I go to the bank and say, I need a $10 million loan. And the bank has to decide if they want to underwrite that risk. With passive investment options, it's true that the marketplace isn't sitting there going, it's not part of it. It's a secondary market. It's not a primary market where the equities are doing raises, and it's not a debt market where they're borrowing money. How do you think about this argument inside of the wrapper of valuations? Or do you just not think about it at all?
It's almost like, cause I asked him about like, do fundamentals not matter anymore? He's like, no, they do. It's almost like what they're saying is they matter at extremes. So like, for instance, he used the example of GameStop, which you were just talking about, which is at a certain point, GameStop got so detached from the fundamentals that like, it did matter. Although it didn't matter on the way up. No, I don't think anybody, following Roaring Kitty was like looking at the balance sheet, to try to decide whether they should be buying it, during that whole frenzy. But at a certain point, it did matter. And think about the other side of it. Like that was the whole David Einhorn podcast, which is, David Einhorn was kind of saying, nobody cares about these small cap value stocks, so I'm not getting multiple expansion anymore. But at the bottom of the barrel, if like the company's buying back 10% of its shares or something, like that's cash in my pocket. So I don't care whether the market cares about it or not. Or Mike gave the example in the podcast of like, if something got cheap enough and people just took it private, well, then fundamentals matter down there. So it's almost like fundamentals matter less, but they matter in extremes. And again, they do matter because you can't argue. I don't think you can argue what happened with NVIDIA was purely the result of passive flows. I mean, the stock, what did it triple? I don't know what it did, but clearly that was happening because its business was getting better. But also behind the scenes, there is like this slow upward pressure, I think, that also goes on from the fact that these passive flows are going in. So it's not like fundamentals don't matter, but they might matter less. And I think they probably, what Einhorn was arguing is they matter even less, like once you get outside of the large cap stocks, once you get in the small Russell 2000 type stocks, there just aren't as many people paying attention as there were back in the day.
And it feels like, and this was the Einhorn point, another episode, highly, highly recommend people go back and re-listen to that one because this is the Ritholtz interview, right?
That's Barry Ritholtz, Masters in Business, David Einhorn is really, really good.
Yeah, really great interview because fundamentals don't matter until you're either at an extreme, I guess, and I'd put an and on this too, if you're at an extreme, or they matter when you need to raise equity or borrow. And that is a decision between those shareholders. So GameStop, you can sell all the story that you want to the shareholders, whether or not they understand the thing, but surviving that equity raise then puts the cash in the bank so that, I'm not saying fundamentals don't matter after that anymore, but that was the transaction that they mattered for. Fundamentals didn't really matter to the stock price on the index. And it's the same thing we see with NVIDIA, the same thing we see with any of these companies. And one of the big questions we have to ask about our largest companies that are largely, financed from earnings and cash flows right now, Apple's probably not going to go out and do a stock offering. What they do in the debt markets is indicative of what they need for short-term borrowing needs and other things, or share repurchases or whatever else. Those are the parts of the valuation that you just have to ask, like, are they getting these deals done? That layer of thinking is really helpful to me for understanding sort of the landscape of large cap technology in some of these companies over the last few years. And also looking at stuff like, I think Apple's at a record high valuation right now, I want to say, or close to it at least. And when I see stuff like that, you have to ask that question, does this matter? Well, are they issuing stock or are they trying to borrow money? Let's look at those terms, because that's maybe not the extreme scenario of something going horribly right or horribly wrong, but that is the scenario of is when somebody is applying actual valuation methodologies to giving them money through the lens of thinking about it, what's happening here?
Yeah, so the other thing I think the other thing that's important to keep in mind is like the idea of fundamentals don't matter is a continuum. So, like, I don't think that anybody exists at the end of the fundamentals don't matter at all. Like, Mike gave a bunch of examples in the podcast why fundamentals do matter. So he's not saying like fundamentals are completely irrelevant. I mean, NVIDIA wouldn't have happened if fundamentals didn't matter because no one would have cared that its business is going up. They'd have just been like, fine. You know, also at the other end, basically, fundamentals drive everything and nothing else matters. Like, that's not right either. Like, I know Mike's work obviously would tell you that. Like, our friend Ben Hunt has talked a lot about narrative and how much that impacts the market. Like, so for us, for those of us that believe fundamentals are important, and I do believe that, we can't just ignore the arguments of Mike Green and the arguments of Ben Hunt and just say the fundamentals are matter and they're eventually going to matter. I mean, what we've seen in the market over the past decade is they've mattered less. I think that's a fair statement. So I think it's important for all of us, no matter what we believe is going to happen in the future, to at least say we need to understand these arguments. We need to interpret them. And if you're a factor investor like me, there's things you can do behind the scenes. You know, you can use more momentum. You could use some stuff off of some of these guys' work. There's things you can do to maybe enhance your strategy if you believe, yes, fundamentals do matter, but also like this other stuff is mattering too. So there's some things I can do to enhance my strategy to say, like, I don't want to go pure small cap value here and like hope the multiple is going to expand. I need to do other things as well, because if the multiple doesn't expand, I'll put myself in a bad position.
Let's take it past this. I want to jump to your number 3. Let's look at the importance of looking beyond aggregates. What does that mean to you? And aggregates means a couple of different things here. So unpack this statement.
Yeah, he had a great example. The idea is whenever you put like a bunch of diverse groups together and like come up with some sort of composite of data, you have to understand that like the final result doesn't necessarily tell you about what was going on behind the scenes in the data. And he had a great example, and I'll put the chart in this podcast. I forgot to put it in the other podcast, but like his idea, basically, a lot of people are saying, well, the bottom, you know, I don't know if it's quintile or quartile or whatever it is, like the bottom quintile of people in terms of income have a lot more assets than they used to. Their situation is getting better and better and better. This is a great sign. Well, one of the things he pointed out that you've got to keep in mind as you say that is we've got the baby boomers retiring right now. Like I have someone who's close to me who's retiring right now with a $7 million portfolio. Like when he retires with a $7 million portfolio, he goes into the bottom quintile of income and he has a lot of assets. And so basically he has now inflated the assets of the bottom quintile of income, but it's not telling you anything about the world's getting better and the people at the bottom are doing better. And so, like, and I'm sure people could, you know, maybe argue on the other side with different data, but that was my point, is it's really important when you see these charts, because if you just saw someone post that chart on Twitter, or look what's going on with the assets of people in the bottom quintile of income, you would have maybe had the wrong conclusion about that. And that applies to so many different things that are going on. It applies to inflation stats, and everybody else is seeing different things behind the scenes. Like, whenever you look at anything that's an aggregate, you've got to also understand that there's a bunch of different things going on behind the scenes, and you can have like really bifurcated situations where what's going on behind the scenes is very different for one group than the other group.
This concept, which is, I think I'm realizing just now what part of the thing that I love hearing Mike Green talk about this stuff. He is I don't want to say a better version of Nassim Taleb, because don't take that the wrong way. I'm about to get blocked on Twitter by Nassim Taleb probably. It's like a different type of approach. It's a different approach to saying some of the same things. I have loved all the Nassim Taleb books for the sense of just like how they provoke thought. It's such a cool exercise. So if all of a sudden on this call, Bill Gates appears on this call and we were measuring the average net worth of the show until Bill Gates walks into the room, and this is one of Taleb's examples, not exactly, but you know what I mean, close enough. And it's, that shifts the number in a dramatic way. All of a sudden, it's the average person here is, you know, a billionaire, as opposed to the average person is a much lesser number, presumably. I know you got that boat and all the other.
I know that's true in my case. So I don't know about yours, but it definitely is true in my case. I'm a bit short of billionaire at this point.
Let's just say we're both a couple short of the 3 comma club. This idea though is that you have to look through to the demographics. You have to look through to the situation. You have to unpack the aggregate to actually understand the story it's telling. This idea that when we look at asset levels and income levels, that the largest part of the population, the baby boomers, are basically retiring. Their income's going to the lowest, but the net worth in their house, the net worth in their 401ks, all these things are the highest. It's going to skew the rest of the data. It's like Bill Gates showing up on this call, or Jeff Bezos, or take your pick of somebody who's got a lot of money. You introduce another thing into the equation that distorts what you understand as the average. that can be problematic. That can be problematic for policy. That can be problematic for telling stories about what's actually going on. So when he makes this point, he's just saying, follow this up with another question. Don't let this thing be the one thing that stands alone because it's a problematic, not problematic statistic. It's a problematic tool to just rely on the aggregates to tell the entire story. There's always a story inside of this too.
Yeah, I'm going to blend our next lesson into this because this is really important because this really gets into like Fed policy and interest rates as well, because there are different people in the economy. I mean, Mike talked about the bifurcated economy. I mean, we've got people who have a lot of money. We got people who have high income. We got people who have very little money. And the way the Fed is operating impacts those people differently. And that's, again, goes back to this idea that there's different things behind, it's not like just the Fed hikes the Fed fund rate and here's what's happened to everybody. Like, it's completely different. Like, if you're sitting there on $1 billion portfolio and you have zero debt, guess what? The Fed hiking the interest rate is pretty good for you. You're getting a bunch of income now that you didn't have before. Now, that's not the average person. That's not the average example. So this idea that when the Fed hikes interest rates, it's like stimulative, I think is totally wrong. But it is stimulative for some people. And then the other person, the person who's got the adjustable rate mortgage and a bunch of, credit card debt and stuff, that person's in huge trouble when the Fed starts hiking interest rates. Like, that person has a bunch of short-term debt, which is going to go up, as part of the interest rate hikes. That person's hurt. So it just, again, goes back to this idea that, like, when the Fed hikes interest rates, it's not some aggregate thing that, impacts the economy in the same way. It impacts people differently, it impacts businesses differently. And it's just important for us to think about that when we analyze these things and understand it's not just one effect.
In financial planning conversations, one of the regular things we talk about the most when we talk about markets is, what does this mean, broad level? What does this mean for you? Inflation, we've covered this ad nauseum on these podcasts. The rate of inflation, we can dice it up, we can measure it in a bunch of different ways. It's one thing to understand what does this likely mean for the economy. It's another thing, what does this likely mean for your situation? If you are a 67-year-old on a fixed income where Medicare is providing for your benefits for your health insurance, and you have a home health aid, and the cost of that is going up at a rate more than the CPI, you have to think about inflation very differently than somebody who's 40 years old, is locked in on a 30-year mortgage with their house, and has a stable job with slowly but frustratingly increasing wages. Those are very different pieces of life. Or the person who's 25, out of school with a bunch of variable rate student loan debt and rent increases that keep coming through. These are multiple variations on the same economic data points that read through to the individual in a very different lived and experienced way. Fed tools as a policy tool, all these things as just blunt instruments of measurements and what can be enacted, they have a very wide range of impacts on people in different ways. We as advisors and we as individuals we have to think about this nuance. We have to stop and think and separate, what does this mean for me versus what does this mean for everybody else? And in many cases, what does this mean for my family or the other people I care about or provide for? This nuance is massively important, well beyond the complexities of what the Fed's doing.
Yeah, when you think about it from the Fed side too, they have to think about it too, because how their policies impact the economy, this plays into it. Like, thinking about, like we talked before about, both of us didn't really see what happened in housing happening. Like, the rates would go up so much and housing prices would go up. But if people were enacting policies to try to slow down growth of the housing market, and those policies don't take into account that there's all these fixed rate mortgages who aren't going to be impacted by that, then you're not going to get the policy outcome you thought you were going to get. Now, that wasn't their goal here, but I'm just using that as an example. Like, you're not going to get the outcome you thought you were going to get. So again, going underneath the aggregate and saying, like, what's actually going on here is so important, even for people who make the policies, because it helps them understand what's actually going to happen when I do this.
The hardest part with this in policy is it almost always forces you to ask the question of, who are we going to price out and why? You want to jack those interest rates? You're choking off credit. If you're choking off credit, what's the reason of who you want to choke off the credit from, and why do you want to do it? This isn't to paint an evil face on policymakers. This isn't to say that there's just nefarious purposes in either direction, and I guess there certainly could be, obviously. But it is to say you have to think through, what do these things do? For the Fed for us, we can say all day long, we've joked about this. It's like when you buy the hamburger and it's, 80% fat free, it's 20% fat. When you say we will look for economic data to soften, and that's based on an increase, in the unemployment rate, and you go, well, that means people have to lose their jobs. This is not the kind side of discussing it. It's the reality. It's the economic reality of the world and the markets that we live in. But when you want to raise rates, you're talking about choking off credit. When you're talking about choking off credit, that means people who are trying to apply for stuff are getting declined and shut down. So which people, which corporations, which things do you want to take that access away from? This goes back to why it's so hard to aggregate these things, why it's so complex.
Yeah, and it's why it's so complex to execute policy. Like, we all want to criticize the Fed and everybody who does it, but it's like they live in a very difficult world. They're taking something, there might be this aggregate data, but they're taking something where there's all these diverse things within the aggregate, and they've got to figure out like how that's going to impact the overall. And it's very, very hard to do. They've got a very tough job. I certainly don't want to be nor am I qualified in any way to be the chairman of the Federal Reserve.
You're qualified
I wouldn't
in every way.
I wouldn't take it if they offered it to me, Matt, because I'm not competent enough to do it.
I nominate you. And if we think about it from that, if we give the grace of saying it's just a really hard job, it's an impossible task and it's a hard job to be in the center of this thing. The other part is then you start to add things to the equation of who's resilient and who's not. And this is one of what I think is like the really hard pieces in the personal side of financial planning, because then you have the policy change that changes that rate structure or changes the availability of real estate or changes who gets laid off in the workforce. I think a lot about in the financial crisis, I'm early on in my profession as a financial advisor, financial planner, and I ended up working with a number of kind of like 55 to 60-year-olds who got laid off in the years past the financial crisis. So in that like 5-year window afterwards. And what was really hard about those situations as they would come up is they were part of, supposedly the labor markets were healing, but part of the way the labor markets were healing were companies were saying, in this now close to zero interest rate world where everybody's still worried about a double dip recession, we need to cut our costs. So in the next double dip recession, we don't get hit the way we just got hit in the last recession. And one of the common answers we saw to do that was take the most highly compensated people in your workforce that aren't retired yet and either offer them a package or get them out the door early because they're your highest cost of employee to have on the books. And that led to a lot of people in that 55 to 60-year-old or so demographic getting laid off who weren't ready to retire yet, who all of a sudden were without work and nobody wanted to hire them back, certainly not at the wage that they were used to receiving. This was an upsetting and troubling thing, and it was hard to advise clients on something that felt to them unfair, but was also the reality of what had to be solved for. So inside of that, you're going, and that's not a government policy decision, that's a corporate policy decision to do this stuff. You still have to deal with the reality that lands you. So now that triggers, what do? Do we accept the lower wage? Do we sell the house that's still slightly maybe inflated in price, even though it's down off the peak from a few years ago? That was a really hard thing in the wake of the housing crisis. All these calculations get disrupted in different pieces of different demographies, like in their brains. And it's weird when you see these things kind of pool together, because it just speaks to how complex this situation is. It speaks to how hard it is on a human level to sometimes just have to grapple with crap that's just not fair.
Let's shift to lesson 5 here. And this is one we only talked about this a little bit with Mike, but I wanted to bring it up because like yesterday was one of the craziest days we've seen in a long time in the market. I think the Russell 2000 was up 3.6%. The S&P 500 was down. I think the Mag 7, we'll put up a little chart here that I actually have that I can put in the podcast. But so the Russell 2000 was up 3.6%. The S&P equal weight was up 1.1. The S&P 500 was down 88 basis points. The NASDAQ was down 2%. The Mag 7 was down 5%. So that's a pretty crazy situation to have happen on one day. And the lesson here was there's multiple markets. It's not just the market. And this got, I've obviously known this because of what's been going on, but like it hit me too when I was writing our client letter recently, because I was just putting in the performance of all the indexes, and like, looking at the S&P 500 this year against the Russell 2000 is quite striking. I mean, the Russell 2000 is barely up this year. Like the Russell 2000 value is actually down this year, or at least it was until the other day. And the S&P 500 is up a lot. So it's just the lesson here is just there's a lot going on behind the scenes. Again, going into this idea of digging into aggregates, there's a lot going on inside the market that maybe there's different markets for different people. So people who are invested in one way are having a very different market right now than people who are invested in another way. And I think that's always just important. Like we always love to put these market aggregates out there, and the S&P 500 was up this, and the S&P 500 is the market because the market cap weighted. I mean, and you could say you have to include all the small cap stocks, but they at this point don't even. They're like a rounding error. Even if you put them all in the S&P 500, it's like or the total market index. They're like a rounding error relative to the S&P 500. But it is just like this idea that it's important to pay attention to what's going on behind the scenes, and that there are these different markets. I think is important for everybody to recognize, and just to know when we're looking at all this data. What's going on in the S&P 500 is not necessarily telling you, especially this year, about what's going on with your average company, because what's going on with your average company, I think we had in one of our other podcasts, I think something like in the Russell 1000, like 40 some odd % of the stocks were down for the year. So it just shows you that there's a lot more going on behind the scenes than you might see in like these major market indexes.
I like this idea. The $5 word here is dispersion. It's the idea that things can be different from what the average says, and we can measure how much on average are things different from the average. That's probably a terrible statistical explanation of the thing, but I think it gets to the heart of this idea here. We are seeing this in spades this year, and I'm seeing it a lot on the planning level with employees in different sectors. So it's a very common thing when we're talking with clients who are employed by either Fortune 500 companies or like large private companies or even small private companies. Understanding the sector that you're a part of and how that exposure to your wage, which in many cases is a big source of income and how people pay their expenses, is tied to the sensitivities of that industry and the broader markets. The last couple of years, if you're working for a tech company, life's pretty good because your wage is up, your stock-based compensation looks great, the performance of that stock looks great. Those are all things that make everything win on paper. But it's hard in those environments to say, what are some other markets? What are some diversifying elements we can try to invest in these places? Conversely, if you work in a boring old non-tech industry, this has been a great argument in the last few years where you would say, or we would say with clients working through the plan, your business is not sensitive or economically sensitive exactly to things like these tech names and these tech companies. You should get your exposure there because you and your very boring local only business that can't scale to this level, you want to have exposure to other things on the balance sheet that scales in those ways that you never will with your wage and your income level. When you start to approach it as markets of markets in different combinations of these things, and especially when you start to split up capital, the money we have on our balance sheet, and labor, wages, what we make from that and how we pay for our expenses, it's a really useful thinking tool to look at the multitudes of markets. In a day like, 7/11 2024, when stuff goes absolutely wacky, is the indication that, hey, pay attention to this stuff. It creates opportunities for you. That's a feature, not a bug.
Yeah, so two things on that. One is I should talk about this dispersion thing because you mentioned it. It's one of the things I've learned. I don't know how great the implications are for your average investor, but this idea that, and I won't go into tons of detail, but the idea is like what goes on in terms of options and volatility. You can end up in these situations where the market's pinned at a certain price. And that's what a lot of these guys think is going on right now. And so if you're a believer in that, what happens is if something goes up, something else has to go down because the market's pinned. And that's how a lot of those guys will explain what you saw the other day. And what you've seen recently, where basically you've seen these large tech stocks going up and you've seen the value type stocks going down, is again, like if something's going up, something else has to be going down. Well, that reversed very hard the other day. Like that's how you can explain the Russell 2000. And I'll put this other chart that I had in here. This is actually pretty crazy. This is from Bespoke. The Russell 2000 was up 3% with the S&P down on the day. There's been just one other trading day since 1979 where that's ever happened. So that's a pretty crazy thing, and that may support some of these arguments. Now, Bob Elliott had some other explanations in terms of hedge fund short covering and like in the value small type names, which
I'll
could
tell
be
you what
too.
happened in 1979. ETFs,
You know that? I don't know what happened in
passive fund flows did that.
What happened is I was 3 in 1979.
Yeah.
Besides that, I probably was like playing with a rattle or something. I don't even know what I was doing, but if I was still doing that at 3 years old, which would have been weird, I guess. But nonetheless, nonetheless, like it is interesting to me, and this is a little bit of a tangent, but whenever these weird things happen that haven't happened in a long time, like it does make me think about like what's going on behind the scenes in the market. And and this gets into Mike's stuff and some other people we've talked to. And it's just like, is there something going on behind the scenes that I really need to pay attention to? Like, for instance, and we're not going to get into a debate about climate change here, Matt, on our planning podcast, but like, so I live in Lower Connecticut, right? So when I was growing up, there were like snowbanks, like in the winter, like on the side of the house, you'd be shoveling all the time. Now, we get a few inches of snow. That's basically it. So just going back to this point, something has changed. I don't know what it is changed. I don't want to argue that on a financial podcast, but something weird is going on that has changed where the climate is completely different now than it was then. Like we don't get the big snow winters anymore. And the same thing with the markets. Like something's going on weird behind the scenes when you get these types of situations. And it may not mean anything to your average investor, but to me, it's interesting to think about it and just to say, like, I want to learn about when I'm seeing these outlier events, I want to learn about what's going on. I want to talk to people like Mike. I want to talk to the options guys. I want to try to figure out what it is, even if I can't, because I think it's important just to understand it and to know it.
I was at a semi-charitable event earlier this week, and part of it was in partnership with a marine lab. And they were just talking about some of these fish migration patterns. And it's one of those things, this is not a climate statement or pinning causality on anything, but it's just the observation, like you and the snowbanks, where they go, this particular type of fish, maybe it was pogies, like would always wash up on these particular beaches in Maine because the whales would chase them or something would chase them from like offshore, and they would end up in this location. And it's just been that way for years. And all of a sudden, in the last like 1 or 2 years, they're showing up like further and further south. And it's because these currents have just changed where they're flowing, and it's in a different place. And this is the kind of stuff that you have to look at and you go, well, that's weird. And now you have to go, A, it's happening because there it is. And B, what does this mean for me? What do we do about it? No policy description there. I have no expertise in marina or any of this stuff. But I can say when you see something and it's weird and then you ask the question, what do I do about it? It's the same with dispersion. It's the same with some of this stuff. It's not to say go out and hedge your risk with 0 DTE options or something. It's not out there to say YOLO your life with 0 DTE options. It is to say understanding that the market dynamics have shifted. And in the same way, we've seen market shifts in like what caused the crash in 87, and not getting into all that either. But when we get into this stuff, we go, the market's function, it's a system. There's plumbing. There's stuff behind the scenes that are the way things operate. And they go through different phases over time. Whatever the phases that we're seeing right now, A, is different from whatever we experienced in 1979, the last time that happened with the differential between, what was it, the S&P and the Russell, or the NASDAQ and the Russell or whatever?
Yeah, it was basically the Russell up 3% and the S&P down on the same day.
What that's indicative of is something weird is going on, and you should be aware of wherever your investments are or whatever you're exposed to. Did a normal amount of weirdness happen to you on July 11th? Or did a unexpectedly even weirder amount of weirdness happen to you? And that's the question that you want to ask when you see this stuff happening.
I just love to ask why with all this stuff. Not necessarily to have a conclusion or to figure out the solution. Like I could either pretend, if I don't have snow in my driveway, I could either pretend that next year the snow's coming and I'm going to have 14 feet of snow in my driveway, or I could ask why. Why is this happening, and try to learn about it. And it's the same thing with these weird things that happen in the market. It's the same thing with the idea of, well, maybe, when I was buying these small cap value stocks, I was getting, multiple expansion a lot more than I'm getting now. Like I could ask myself, why is that happening? Or I could just say, you know what, fundamentals will reign again, and shake my fist and be like, this is, and that's it. But I think the better answer is to ask why about all this stuff. And it's the same thing like with some of the inflation stuff. Like, a lot of people think interest rates are going back. Like there's still a huge percentage of people who believe interest rates and like inflation are just going back to where they were. But there might be contradictory evidence that although maybe they come down from where they are here, they may not go back to zero. Like that world we were used to may not return. So when I'm seeing these differences, I may want to ask why, what's fundamentally causing it, and then maybe I can learn about it so that I don't necessarily have an opinion that's not informed about it. And I think that's the most important thing with all this stuff is just being able to ask why and being able to ask questions at least makes you a more informed investor.
Why am I reading this now, and what does this mean to me, if anything? And it's okay on that second one in particular to say, like, this doesn't matter to me, or I don't know what to do with this piece of information. don't be the crazy guy standing out there with your shovel jack, yelling at the sky that there's no snow for you to shovel. That's probably not a good use of your time. You might as well be doing another podcast. You'd be just as crazy for that, perhaps. But the idea of, why am I reading this now? Don't be an unintelligent or a consumer of information without asking that question. But then also, what does this mean for me? And do I care? And it's okay in some cases if you don't care, or if you can't uncover the causality that satisfies whatever you're after.
And you've actually perfectly segued into our next lesson, Matt, which is think about the practical implications, because that's always the next question you have to ask yourself is, what does this matter for me? Does it matter for the way I invest? And so let me give you an example. It's a great example of this. And I think we talked about this in another podcast, but for anybody who didn't listen, I'll do it again. So Mike Green has all these arguments about how passive investing is impacting the market. But when you think about it, what does that mean for the market? What it means is the biggest companies are going up more. What does that mean, like in terms of how I should invest? Well, probably if I'm buying the S&P 500 index fund, that's probably pretty good for me. So that probably works out. So Mike Green's conclusions, like people like look at him saying the risks of passive and all this stuff and think, whoa, that he's somehow challenging you should be passively invested. It's the opposite of that. His research leads to support for, at least for now, continuing to be passive invested. Now let's think about Rick Ferry, who we had on the podcast, who does not believe Mike Green's arguments, but basically who's a big believer in low cost and indexing and all that stuff for completely different reasons. But he ends up in the same place as Mike Green. And, I remember you and I were at the Epsilon Connect conference, and there was like a panel about like the market's broken or something. And like they were talking about all this stuff about how the market's broken. And then they asked someone at the end, like, what does this mean? And they're like, buy the S&P 500. So it's like, we can talk about all this stuff, but you've got to get it to the bottom line of what does this mean practically for me? And a lot of this stuff doesn't really mean much. If you're an index investor invested in these index funds, you can really take all of these different, disparate parts of work, and you can really end up in the same conclusion, which is I can just continue to be invested in my index portfolio.
What else are you going to do if you're not, is still one of the most useful investment questions to ask. If you have money that you've earmarked for growth, so if I'm sitting down with a client and we're trying to figure out what's the money for, that's the big answer. If you need it to generate income or generate cash that you're going to withdraw from it, you have one calculation to make. If you needed to generate growth, you have a different calculation to make. If you think that passive investing is corrupting markets and the world's going to end, but you still need growth, you have to ask the question, well, do I want it exposed to things that can go up, or do I want it exposed to things that won't go up but protect my principal? Those fundamental, super simple, just base choices are at the root of everything. And in many cases, you can have an ideological idea, this idea, theory, or whatever about what you think is wrong or broken or not good. And you can still turn right around and say, I think this is bad, but this is the best hedge to the outcome, or this is the best long-term decision that I can make. And that panel, when basically it felt very doom and gloom for the entire conversation about all the things that were broken, all the things that were ruined, all the reasons we should just call it, hang it up right now, go buy the Cougarans and hide in the cornfield or whatever. And yet every one of those people were like, well, the S&P is probably going up in the next 3, 5, 10 years, whatever it is. Incredible.
And that's why the people on that panel were great and Mike's great. I love people who can do that kind of research, because your average investor falls into this trap. I think, and I do too a little bit too, is when you hear this doom and gloom type stuff or things that could lead to negative outcomes, it's like, well, I need to be in cash, or I need to do this, or I need to do that. Like, when people can have these things, they can think through these things that might go wrong, but they can also think about, what does this actually practically mean? And it may not mean anything in terms of how you invest. It just may be something to think about. Like, that's a really tough thing to do. And for a lot of investors, they can't do it. And so that's one of the things, whenever we talk about anything that could potentially have negative implications in the podcast, I always want to talk about is, like, you don't want to take that and translate that into some sort of crazy thing in your investment portfolio where you're in cash for a decade because you're worried about this thing that could potentially happen that may not even happen. Like, you have to think about the practical implications of it. And the guys that are really good at it are able to hold those two things together. They're willing, on one side, like, here are the bad things that might happen, but on the other side, here's how I'm going to practically build a portfolio in the real world. And that can be hard to do, but that you have to do that when you look at this kind of stuff.
I was asked a question for a media thing the other day, and it was about investing mistakes, that kind of thing. And as I was reflecting on what to talk about, one of the things I chose to just express was that post-financial crisis period where two things I saw way too many times, and I think about this a lot and how this has probably shaped a lot of my own philosophy with investing and just the learned experience. And it comes back to these practical implications. I saw a lot of people who were still in cash. So basically the market goes down 50%, people sell everything, they get scared, they fire their advisor, and now 2, 3, 5, 8 years later, they just still have a giant pile of cash. And interest rates were zero, and they didn't do anything, and they missed out on the recovery, they missed out on everything else, and they got the horrible decline right beforehand. And inevitably, there would be the guilt, the shame, the pain of, I know what I missed out on, but I felt like I had to protect myself, and I had to protect myself, and now here I am, what do I do? And it was really hard for them to turn around. Likewise, the people who thought they should move, thought they should get out of their house was worth this amount, then the financial crisis happens, the house value comes back down to here, and they're like, but I could get the other days that it was worth. And they couldn't make the life decision to let go of the thing because even though 3 years ago, this is the price they would have gotten, a year ago or 2 years ago, they would have gotten way more of it. And they couldn't understand why they couldn't get more of it. They already mentally accounted for this thing, the endowment effect, and all the things that go wrong in our brains when we anchor off of these numbers. Those behaviors, when we tie ourselves to these situations, when we lose sight of the practical implications of the decisions that we didn't just make once, but that we're choosing to continue making, that's a really profound point. We might just talk about it. We might only talk to our spouse or not tell our spouse or not tell anybody about these things. Hide in a hole, fire the advisors, fire the professionals, go hide. Don't tell anybody about this thing and miss out on a whole bunch of things that we know we should be doing, what we're scared to do. Then you hear somebody like Mike Green talk and they say, I heard this thing, I thought this was right, it rhymed with my anecdotal evidence, but then I went to the authors of the paper, I kicked the tires some more, and you know what, at the end of the day, here's my thoughts on this, but here's a practical way to do it. That's the standard. And if you're not going to go ring those people up or send them the emails and have the intelligent conversations, you get help, you get yourself put on the right track, and you always, always, always track it back from not just why am I reading this now, but what does this mean for me? Ask why, just like your point earlier. So,
and that's the challenge, when we do what we do. And that's what I was talking about the YouTube covers before, is like when you do, the negativity ends up like, you could have like an hour-long nuanced conversation with Mike Green, and like the one thing that is like the negative thing that could really be bad is what will resonate with people. And some people, to be honest, like if I wanted to grow excess returns greater, we're growing excess returns at a decent rate, but if I wanted to grow it greater, I know how to do it. Basically you need to get the negative macro guys and you just parade them one after the other with these covers that are like doom and gloom and doom and gloom. And there's channels that do that and it works really, really well because that stuff resonates with people. The problem is that stuff almost always causes problems in people's portfolio because it's very hard to listen to that stuff and not go home and be like, oh, I'm going to make this change or I'm going to make this change. And then suddenly you're what you reference. So you're in cash for a decade because of this doom and gloom stuff. So we try to avoid that kind of stuff for that exact reason, because it's just you can have these really nuanced conversations and that like that little piece can get pulled out. So we always try to put context around this stuff, but it's a challenge. And I'm not as good at the behavioral stuff as you are, but like we read that negative stuff, we see those negative YouTube covers and we just react differently to it. Like we for some reason are like drawn to, like the click-through rates are way higher on those negative covers. Like we're just drawn to like, I got to watch this. I got to watch this thing about the end of the world. And it does us no good. And we try to stay away from it, but it's an interesting, thing about the human condition.
Yeah. Average isn't sexy. Average doesn't sell. Nobody wants to be average. Nobody elects to be average. It's one thing to be above it. It's another thing to be, I'm so smart, I'm beyond it. But nobody wants to just take the average. And in many cases, average is a lot worse than the behavioral consequences of getting far less because you thought you were better. Let's talk about the way this shows up. Lesson number 7 from you, the double-edged sword of innovative investing products. But we have so many cool ideas to sell you. What's the problem?
Yeah, what's really cool is I actually think like, thinking in the past, like a lot of times, a lot of these crazy investment products were just, there to generate fees and doing nothing for anybody. Like now I think that's different. So I think like I call this the double-edged sword of innovative investing products, but I think a lot of the ones that are coming out these days especially by people like Simplify, where Mike Green works, return stacking with Corey Hofstein, and those guys from Resolve. Like, these things are really, really good products. Like, these are reasonable fee, really good products that are making the world better. It's giving all of us, like, especially people who know how to use them, it's giving us access to these things that we didn't have before in terms of building portfolios. Like, have you ever looked at pictureperfectportfolios.com? It's Nomadic Samuel. Yeah, like that. He's done so many, like, he's taken these new products that are out there and he's created some crazy portfolios that have some crazy good statistics, not in terms of like blowing the doors off from a return perspective, but in terms of the drawdowns and the risk adjusted returns and like using these things properly. And we talked about one of Simplify's products in the podcast, but like using these things properly, these can be such amazing tools. So I think the positive side of the sword is much bigger than the negative side, but the negative side is when people who don't understand what they are use them. And so you have to, with any investing product you use, you have to understand, what is this trying to accomplish? When is this going to work? When is this not going to work? What are the good periods going to look like? What are the bad periods going to look like? How does this work with the other things I own? And for a lot of people, those questions can be too much. Like, you can't, especially like the one we were talking about was like it was basically a product that's like a high yield product that hedges the credit risk in 3 different ways. And so when you think about it in that way, like, it's tough for someone like you or me. We can do great things with a product like that. We can understand how it fits into a portfolio. We can use it properly. Your average investor has to be a little bit more careful with these types of products because you have to understand what you're doing and how you're doing it before you can use these things properly. And it's why working with advisors, I think probably a lot of people who use those kind of products are probably using them. They're either a sophisticated investor or they're using them through an advisor who understands it. So I think these things are awesome. Like, I think there's so many cool things. Like, when I think about building client portfolios, when I think about building my own portfolios, I mean, we've used some of this stuff for our clients. Like, I think there's so many things you can do here to create really cool outcomes. It's just, you also have to understand, like, if I'm going to use this thing, I have to know what's in it. I have to know when it works and when it doesn't work, because suddenly you end up putting like a huge portion of your assets in something that was intended to be a small position that hedges something else. And like, suddenly you've got all your assets in there and then you're in trouble. And so I just think that's why I got to the double-edged sword, is you have to understand what these things are before you use them.
You have to understand how you, the individual, use them and why they make sense to you. This goes back to our conversations about, we talk about, guess what? You own a business, you're in private equity. If we're talking about equity risks, we're talking about the same types of risks as if I'm a fractional owner in a business, just with markets and the other stuff that's in the middle that changes from private to public. You own a house, you're a private real estate investor. Congratulations. Yes, it's not an investment. You're there for consumption or whatever else, or shelter, blah, 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 blah. But the idea is you don't own it in a separate vehicle and whatever else. This logic, though, carries across. And when we think about innovative investing products, we have to think back to ways that we understand them in our own situation and why they're offering us something that we can't otherwise access. And I'll take it back again to, if you work in a boring ho-hum business as far away from tech as you possibly can, it's really useful if you work in or you own that business. Maybe you're the administrative assistant for like an HVAC company or something. Guess what? An investment in something outside of your industry and like tech companies or whatever, that's a brilliant way for you to get exposure that's diversifying away from the equity risk that you're exposed to in your job. The innovative investing products that are out there range from incredibly general, like just you can go out and buy a tech fund because you don't work in that industry, to incredibly specific, like here's 3 ways to hedge, credit risk exposure in a high yield fund and blah, blah, blah. Super cool, super useful. You can take it down to what it is, but still take it down to its component parts, understand why it fits for you in what way inside of your portfolio. And then I'm with you, the net benefits of these things being available and being there for access, they're really useful. We've been watching family office clients use stuff like this for years to great effect. It's really wonderful to think that there's other ways for people to gain access to strategies and concepts and more simple vehicles these days than you ever could before. Just don't get suckered into a bunch of bad ideas or jumping through a million hoops just to basically get treasury returns or market returns. That's the sad reality I see way too much in other people's portfolios.
The way to differentiate it is the education part. So the guys that are doing it right, the Simplifies of the world, the return stacking guys, you'll see them doing tons and tons of work around educating people about what this product is, when it works, when it doesn't work. that's how you know. You know when people are trying to do that, they're really putting these products out in the world because they want them to be used properly. They're not just telling you about the great things about this. They're telling you when they work. They're telling you when they don't work. They're telling you what their purpose is. So I think that's how you differentiate it. And it's hard. I mean, if you're not a sophisticated investor, and most people who listen to us are probably at least fairly sophisticated investors. If you're not a sophisticated investor, you shouldn't be using this kind of stuff without talking to somebody who is, like an advisor or somebody like that. But even sophisticated investors, even me, like I can look at some of these products, I can be like, wait, I got to really understand what's going on in these credit default swaps or something like that. It can be complicated. So it's just important to understand what they are. But I think in general, it's really, really cool. Like I think there's so many cool things you can do with a portfolio now that you couldn't do before that are just better outcomes for everybody involved.
I wish all investors could have the experience of sitting down, and there's great resources for this. Sit down with somebody who does manager due diligence as a profession. Go listen to some of the Ted Seides interviews where they actually do some of this stuff on the Capital Allocators podcast and those places. Or if you know somebody, or you can sit through an experience of somebody else interviewing and peppering somebody like this with questions to say, black box isn't going to cut it. All the education, all the other things, great, but now help me make sure I can translate this back to how I'm going to use this tool. It's not easy. It's a science. There's also an art to it. It's really worth gaining that experience of seeing that firsthand, because it's really humbling if you don't do it, to see just how good at this process somebody else can be. But also it's the awareness of you can get to an answer. You can get back to a practical reality if you have a process. But if you don't have a process, you're probably just going to make a decision with your gut. And if you haven't checked, your gut's not always the best thing to go on. Speaking of which, lesson number 8, elections. They impact everything. I should just bet all my money on one candidate and call it a day, right?
Yeah, so we talked to Mike a little bit about this. We'll do this as our last lesson, but we talked to Mike about this. And again, we don't want to get into like the long-term implications 5 years from now. But I think it's just interesting. Like people tend to think like the day after the election, basically what happens if this outcome happens, the market's going to do this. And they're pretty much always wrong. And we got into this with Mike because there's so much going on in terms of like hedging outcomes and things in the options market that's going on leading into an election. Like I remember the Trump election was the greatest example of this, like the one that was going to be, not the first one, the second one that was going to be like a disputed election between Trump and Biden. And basically the world was going to devolve into chaos and the market was going to tank. And we heard all this stuff. And by the way, like pretty much the world did devolve into chaos. We did have a bunch of problems. We had a disputed election. We had all kinds of stuff going on at the Capitol. But yet the market didn't go down. And that's a great example of this. Like there's so many things going on behind the scenes that you probably don't understand. And a lot of times if people are hedging for the worst possible outcome, unless the outcome is truly catastrophic, you can see a reversal after the election in the other direction. So this was more just, so many people want to make these bets, like not necessarily like the 4-year bet on tax policy or something like that. It's more like the bet about how the market's going to react like in the immediate, days and months after the election. And those are almost always wrong because you don't just have to think about like how would the market feel about each candidate. You also have to think about like what's being hedged, what's being done in preparation for this. What are people doing? Because those flows kick off, as you get into the election and you start to see reversals and stuff like that. So that was the big lesson when we talked to Mike, is he kind of said the same thing, is you just have to be very careful about thinking about how the market's going to immediately react to any election outcome because you probably don't know.
Listening to him explain that, I couldn't help but think too, those decisions to hedge those outcomes, to put those positions on, to think through these, those are all just active investment decisions. And those end up reflected in the price and then the action in the days following of these events. So when I think back to that potentially contested election and all the other shenanigans that went on with that whole event, it's okay. So a bunch of people put protection on. Then when the stuff was happening, and the market started to go, this isn't as big of a deal, those positions come off, things press in the other direction, you see the reversals, you see all the stuff. It's really hard to predict, but the people who are willing to put those positions on in advance, that's some of the stuff that set the market price today. That's a really important function, and I hate to say it, I love to say it. That's a really good thing about markets. That's pretty friggin' amazing.
So just before we wrap up, I should have put this in the beginning, but I was getting my my abnormal returns email today. I don't know if you get that, of the best podcast.
Oh, I do.
And it turns out Jack Forehand is not represented this week in the Indie Best podcast, but Matt Ziegler is represented twice in the Best podcast.
That is abnormal.
For anyone who wants to hear more of Matt and maybe less of me, just Matt has his own channel, Cultish Creative. He has a Just Press Record podcast. It's really, really awesome, bringing two people together from different worlds, and he finds a commonality between them. Also on the Epsilon Theory channel, The Intentional Investor, our friend Wes Gray, who's been on our podcast a bunch of times, was Matt's guest this week. So if you want more of Matt, you can find, and if you believe Abnormal Returns, that those were the best podcasts of the week, which I do, you can find those on those channels. So I just want to say that before we wrap up.
And if nothing else, listen to Wes's interview. Fantastic. A lot of the stuff we're talking about here, I actually think we talk about a lot of the practical implications of that in his life story, right down to, now, did you see the absolutely delightful picture of Wes at like 10 years old with his prize-winning cow from the story he told that he dropped in the comments?
But
that is a thing of beauty. If you want stories
about getting called by billionaires while you're like dealing with cows at the same time, or was it horses or cows?
Yeah, grandma's horses got out. This is the kind of stuff.
This is the kind of stuff
realities. This is the practical realities of what it actually means to be dealing with this stuff. And I think it's super, super important. Or likewise, just the rules of community building with Angie Coley and Dave Nottig, who are on the last Just Press Record. It's, hey, people are messy. And guess what? Those two brilliant individuals were able to connect that all to from lessons they learned from mosh pits going to rock shows after the last several decades of their life. Practical implications rule them all. Finding ways to think through this stuff is just really exciting and really interesting. I love doing these conversations with you because we get to actually think through this out loud and just show we don't have all the answers, but we can have an intelligent conversation about this stuff. And then we all got to go back to our families, to our clients and everybody else, and just help translate this stuff for them. There's no better way to help translate this stuff or navigate markets for ourselves and others than to just learn to talk to people about this stuff, get out of just our own heads on it. That's infinitely valuable to me, to just get outside of my own head and hear what other people are thinking and doing without it being like a requirement to be sold some crap.
So definitely recommend everyone check that out. Cultish Creative on YouTube is Just Press Record. Epsilon Theory on YouTube is The Intentional Investor. And I'm on vacation now, so I'm going to go have a margarita. We've been doing this for an hour and 6 minutes. So thank you everybody for joining us, and we will see you next week.
Cheers.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino, and follow Matt on Twitter at Cultish Creative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.